Welcome to my video. I'll trust you'll find it helpful and informative. Please remember to like and subscribe. Thank you.
Hey guys, good evening. We are going to look at question 1, the accounting equation including VAT, and you can expect something very similar in your assignment. I called the company ABC Limited for April 2021. I guess I could have made it 2022, but then I would have to choose February, so let's work with April 2021. Company ABC is a registered VAT vendor, trades only with other registered VAT vendors who can provide tax invoices. It charges 50% VAT on all its sales. It's telling you that all amounts are inclusive of their VAT unless not applicable. And then important, the perpetual inventory method is used. And what it means, if they tell us that the perpetual inventory method is used, it means that every time we are going to record a sale, we will also have to record the cost of sale because we are using perpetual inventory method. If it was periodic, then it wouldn't have been an issue. Then there would be no cost of sales. But in this case, there is. And it is on purpose because this is a little bit more difficult than the other way of doing it. So you need to know how to do this in the exam. Also, more likely in the exam that you will have the perpetual inventory method. Okay. They have separate VAT input and VAT output accounts. Okay. And that is just because when we are working with the accounting equation, we cannot just work with a VAT control account. We need separate input and output accounts because VAT input is current assets and your VAT output is a current liability. So they are leaning on completely different sides of the accounting equation. Now, what I'm going to do, I'm going to skip between the Word document and the Excel document that we have here. So what I've done in the Excel document, just like you will have in your answer book, you have this little table here that says date assets equals owner's equity plus liabilities. What I've added to you is the broader definition of owner's equity, where I said owner's equity is capital minus drawings plus income minus expenses. And also what you will not have in your answer book is this calculation or remark that I am making here. Okay, so let's have a look at the first thing that's happening. It's telling us, oh, sorry, that's not the document I wanted to open. This is the one. It says that the owner is contributing cash to the business. Okay, so you will know that if it is a cash contribution, it is a capital contribution. And because it is cash, there's no value added. So you cannot have value added cash. So when we record that transaction, we obviously, like always, we go and we look at the date, which is given. Okay. There is an asset account here that is going to be debited, and that is asset account is bank. That is where the money is going to reflect. Okay, so that is on the asset side. For every debit there must be a credit, and so the credit account here is simply capital, and there will be no liabilities. Okay, but of course I just prefer to do it this way. I identify the accounts first, and then after identifying the account, I say that there is an increase of that full amount in my bank, and there is also an increase in my owner's equity of that same amount. Okay, and here I've given you a remark. I said there is no VAT applicable to this transaction. So that is for the first transaction that we have. Then the second one, it says there is a cash sale of trading inventory with a selling price of this. So they give us the selling price. they say there is a markup of 71% on the cost price. So here we are going to have two entries. We're going to record the sale of the trading inventory, and we are also going to record the cost of sale. So let's do that quickly. Okay, so once again, we identify the date, and now we say, okay, there is going to be an increase, which means that it is going to be debited to an asset account that once again is bank, because if we have cash sales, the money is going to go into our bank and they give us that selling price. That entire amount is going into our bank account. But when we make a sale, there is also another asset account that is decreasing, and that will then of course be credited, and that account, sorry, I don't want to show you that yet. I want to do that yet. That account is of course inventory. Okay, so this is the accounts that's happening on the asset side, and obviously there is going to be happening something on the owner's equity side as well, because if we make a sale, there is an income. So the owner's equity is also increasing, but now not with the full amount. We have to divide it with 1.15 because the sale is for the VAT exclusive amount. Okay, so if we have VAT exclusive amount there, these two are not the same and the accounting equation must balance. Well, that is because it causes an increase in our liabilities, and that increase in liability is of course our output VAT that will be credited, and on this side the account that will be credited is sales. Okay, so that's the simple part. Now let's go and look at what is happening with our inventory. Okay, so here something is going to decrease, and this will be our cost of sales. And so the way you do it is you go bank sales output VAT, but then the next thing that you have to do is calculate the cost of sales. Now remember, your cost of sales is always calculated on your VAT exclusive amount for the sales that you have there. We know that there's a markup on cost of 71%, so we can divide with 1.71. Then we get 116,093 rand and 42 cent. That is cost of sales, and that is of course going to be debited. But if there is a cost of sale, we are not expecting any VAT. I'm lying to you. There's no VAT for the cost of sales because that VAT we reckoned with long ago when we actually made this purchase. We claimed the VAT back from SARS. So this is how this transaction look, and then obviously it must balance, so the inventory is decreasing with the same amount that you have there for your cost of sales. The remark here, how did we get to the sales? It was the amount given, VAT inclusive, divided by 1.15. The output VAT is simply the difference between these two amounts. The cost of sales is the sales divided by 1.71 because we have the 71% markup, and those are all the remarks that you need. Then we go and we look at the next transaction. And this is the way you do it. You do a transaction by this transaction. You received service income in cash. Now, service income is, of course, a standard VAT item. So we know that there is going to be VAT payable on this for 150. Okay. So once again, if we receive money for service income, identify the date first. Once again, it is going to be our bank account that is going to increase, and they gave us the full amount. Okay. But then as far as our income is concerned, our service income, and we use exactly the words that they give us in the assignment. So as far as the service income is concerned, that will obviously then be credited. It will also increase, but now we are going to divide it with 1.15 because we want the VAT exclusive amount again. And once again, this is going to cause an increase. It's also going to be credited in our output VAT, and that will simply be the difference between the two amounts there. And so if you want to know what I did, those are how I got to those amounts. Then the next thing that we can do is we go and look at the next transaction. Okay. And that one says that the owner, J. Smith, contributed his personal vehicle to the business. The full VAT can be deducted. And what I said to you before is if the owner contributes a vehicle or he contributes machinery or anything like that, we treat it as a sale. As we would have with a sale. So there will be input VAT, and that is why they say to you everything is met. We can deduct the VAT. Okay, so we go there. Don't forget the date. Okay, so in this case, what is the asset account that is increasing? Well, sorry, it is obviously vehicles that is increasing. And the vehicle is not increasing with a full amount, okay? Because remember, it is on this side, it is the capital contribution that will be the full amount. So that's the full amount of the capital. We take out the VAT for the vehicle. And now what is going to happen? Well, there will be another asset account here that is going to be affected and therefore debited. And that asset account is obviously the input VAT. And once again, the input VAT is simply the difference between the two amounts. There are no liabilities that are being created in this case. So here we have the amount divided by 1.15, and the VAT is simply the difference. And that is all you have to do now with regard to that transaction. So let's go and look at the next one. It says here that on the 17th, trading inventory with a selling price of this amount is sold on credit to a creditor. In this case, it is A. Brown, and there's a markup of 50% on cost. So you can already see what's happening here. Yes, there is a sale, but now it is not the bank account that is going to increase. It is our payables or our debtors that is going to increase. So let's have a look there. So on the 17th, there is an asset account that is going to increase and will therefore be debited. That asset account is trade receivables or debtors control, pending, doesn't matter. Won't be penalized if you use the other word. And that is the full amount that is given to us. Okay, if that is the case, then, well, there is a sale on this side that will also increase our owner's equity, but for every debit there's a credit. So this is sales, but the sales is of course that trade receivables amount divided by the VAT. Divided by the 1.15, so that we get the VAT exclusive amount. And then obviously it creates a liability that's also going to be credited. That liability is output VAT. And once again, it is simply the difference between the two amounts. In the first case, we divide with 1.15. In the second case, we just write down the VAT as the difference. But now you know, because we are busy with perpetual, you know that there will be a decrease and therefore a credit in our inventory. And in this case, I said to you, we work from trade receivable to sales. Then, before we calculate the inventory there, we first calculate the cost of sales. The cost of sales going to be debited here. And we know that to get to the cost of sales, we take the sales amount, excluding VAT there, and we divide it with 1.5 in this case, because there is a 50% markup on cost. Okay. And then, of course, that is just the same amount with which our inventory is going to decrease. Nothing happens here. No other liabilities. The cost of sale was calculated by taking the sales, dividing by 1.5, because the 50% was given. Let's have a look at the transaction. Trading inventory with a selling price of 4,327 and 12 cents is returned by A. Brown. It's on the 18th. Okay. It is trade receivables that is going to decrease with the amount given, and therefore it is going to be credited. Then there will be the contra account, which is sales returns. That is, of course, going to be debited. It will also decrease, but it will be the VAT exclusive amount. Okay, which means that the difference will be the input VAT that is now going to be debited because it is an increasing asset account, and it will simply be the difference between those two amounts. Okay, so that's what's happening on the one side. But now, when we previously made the sale, our cost of sales decreased, but now our cost of sales will indeed increase because we have to write it back. So therefore, it is going to be credited, and we have the sale return. It is given, so we can simply take that amount. And we know that when we had a 50% markup on sales there, when we made the sale, we must use the 50% markup when we have the return as well. So it is 3,762.71 divided by 1.50. And of course, that is the cost of sales. And that is offsetted against inventory, which is now increasing and is therefore being debited for the same amount. Okay, if we look at our comments here, the sales return is the amount excluding VAT. The input VAT is simply the difference. The cost of sales is the sales return divided by 1.5. And that is all we need to know. Good. Let's go and look at the second transaction that we're having here on the 18th. So now it says that A. Brown settles his account in full, less a 10% settlement discount. And the balance of was 197,39833 prior to settlement. So they say to us, don't have to go and do all the other calculations. This was prior to the settlement. So this is the balance. But now remember, he is getting a 10% settlement discount. So how do we deal with that? We say, okay, still on the 18th that we are sitting. Now, obviously, if he is paying, then the trade receivables is going to decrease. Okay. And he is not paying us the full amount. He is only paying 90% of it, because if he gets a 10% discount, he only has to pay 90% of it. And that is, of course, now trade receivables that is decreasing with that amount. Okay. On this side, well, nothing is really happening, because the account that is going to be affected here is also asset account, and that is, of course, our bank account, and that is going to be debited. And what I want you to see is that the two amounts stay the same, because remember, when a debtor makes a payment, there it is not a product or service, and so therefore there is absolutely no VAT applicable. But now we'd have to deal with that discount, and this is where it's a bit different from here, because look here we had a transaction on the 18th, then the second transaction on the 18th, but when they give you a discount, you have to treat the as a separate transaction. So let us do that. So we say, okay. Once again, the account that is going to decrease with that difference is, of course, the trade receivables. Okay. Whilst the amount that was due minus the 179, or take the amount that was due and multiply it with 10%. It's the same. Now, this time, the money cannot possibly go into our bank, okay? But because it is something else. So here, the contra account is discount given, okay? It is that trade receivables divided by the 1.15, because we want the VAT exclusive amount, because obviously if we give somebody a discount, we treat it as an expense, and so we are expecting our input VAT to also increase. Okay. They just indicate whether it's going to be debited or credited, and then here, of course, the input VAT will just be the difference between the two amounts, and it is an asset account that is increasing. So don't forget to do that. Now I see I didn't give you all the notes here, so let me just put them in here. And I don't like the fact that my little box doesn't have a border, so let me just do that. And I think that was the only comment that I actually made there. Okay, here with regard to the discount given, it's the amount times 10%. The discount is the trade receivables minus the VAT. And I've already said that, and the VAT is the difference. I said it while I was doing it, but I didn't complete that little table. Okay, next thing that's happening is on the 21st, J. Smith took cash from the safe. Now remember, when he gave cash there at the top, we said it was simply bank and capital. So now he's taking, so it will simply be drawing and something else. But I think it will be petty cash because he is taking it from the safe. He is not taking it from the bank. That's happening on the 21st. Petty cash is now decreasing with the amount that he is taking. And of course, on this side, we know that it is a drawing and it will be the same amount. And I should have said here to you, no VAT applicable. Yes, I did. Okay. Next one is what's happening on the 22nd. Let's go and have a look at that. Not the 22nd, I lie, the 24th. So here we have trading inventory with a selling price of that is sold on credit to B slack, and there's a markup on selling price. Now you will remember that we already had a transaction like that before. Okay. There we had trade receivables that increased. Was it this one? Trade receivables increased and inventory decreased. So this was the one. So this is so we're expecting the exact same format that we had here on the 17th. We expect the same format here again on the 24th. So the thing that is going to increase, and that will therefore be debited again, is our trade receivables, and that always increases with a full amount. Okay. The contra account is, of course, sales will be credited. It is an income, so therefore it is also increasing, but we have to take out the VAT. Okay. If we make a sale, there is a liability that is increasing. That liability is, of course, output VAT that is also being credited, and it is simply the difference between the two amounts. Okay, but because we are working with a perpetual inventory, we know that our inventory is going to decrease and will therefore be credited. Okay, but before we know what that amount is, we first have to calculate the cost of sales that is going to be debited. and it is treated as an expense. And they gave us the markup. The markup was 50% on sales. So we can just multiply it with 50. It's 50%, it doesn't really matter. But here they said it was 50% on sales. So we say sales multiplied by 50%. It was actually 100 minus 50%, but it doesn't matter. So that's the 13,000, and it is the same amount that comes here. No VAT implication for that part because we've dealt with it before. So that's the sales, is the amount divided by 1.15, and your output VAT is simply the difference. We are almost there. So next transaction is the one that's happening on the 25th. It says B Slack is declared insolvent. Debt is to be written off as irrecoverable, and the balance was 172,569 at the start of the month. That is bad news for us. But listen, if the guy is bankrupt, he is bankrupt. So our trade receivables is going to be credited because it is decreasing with that amount. Nothing we can do about that. Okay. But now we have to say, what is the contra account? Well, the contra account is credit losses. It will, of course, be debited because that was credited. We treat it as an expense, so our owner's equity is going down, and we take out the VAT. And we take it out because, obviously, we had to pay the VAT when we sold it to B Slack on credit. Now we declared bankrupt, so we at least want our VAT back. So it is the VAT account, the input VAT that is increasing. We're going to debit it, and it is simply the difference between the two amounts. Okay, so the credit losses is the amount given divided by 1.15, and it seems like the VAT is simply the difference. Okay, the last transaction that we do is we say there's dividend income for the month in cash. So dividend income. Now, please understand, with dividend income, there is no VAT. And that is because with dividend income, there was already a withholding tax paid. So the company that pays the dividend to you or to your company pays the 15% withholding tax over to VAT, and you actually only get paid 85% of what is due to you. So just like pay as you earn is a withholding tax, this is also a withholding tax. So what we say here on the 28th, there is, of course, money that's going into our, no man, don't do that. There's money that's going into our bank account, and the amount was given. It's debited and it is increasing. The contra account here is dividend income. Apologies, it's going to be credited, and the amount will be the same. And did I say there is? Yes, I did make the comment. There's a withholding tax, so therefore there is no VAT. And that, guys, is how you do the accounting equation with VAT. So what is your question, Gareth?
Sorry, I just see that, sorry, that it says that the balance was 172,568 at the start of the month. But then on the 24th, it's the same debtor that we actually sold to. So when we do the calculation for the 25th, should we not also include that 309,000?
Yeah, no, you should, Gareth. You are 100% correct. And I'll tell you why. Because here on the 18th, it actually said A Brown settled account in full, less a 10% settlement discount. The amount was this prior to settlement. And then because they said prior to settlement there, I didn't read properly. And so, of course, you are 100% correct. But now, let me just make then sure. Okay, so we'll have to make a little note here. And that note will have to be, I'm going to move this. And then I'm just going to say equals the 172 plus the 30 there. Okay. And then I'm going to say account for 24th sale. Now, goodness, guys, if somebody does this to you, I hope that you go directly to the police, because surely if he makes this transaction here on the 24th, surely he knows that he's bankrupt. This guy is trying to steal from you. But now in any case, let's do that amount. So it is 203,164.36. And now it means I will have to change some of the other PDF documents as well. But I think what will happen is everything else will just return a result. Now, this was not very clever what I did here. Okay, let me say what I'm going to do. I'm just going to copy this amount and paste as, so that then here when I say it is 203,164.36, then everything should come through. And then I can delete this amount, and I'm just going to say let me do it this way. I'm going to tell you what I'm going to do. I'm going to say that that is equal to that amount that was given. Now I have to go back and find it. The amount that was given, the 172, that, copy that, bring it in there. Just going to paste it there so that I can just write it in here. So this is equal to 172,568.03 plus the 30,596.33. Okay, that. Thank you for watching this video to the end. If you found it valuable, please subscribe and like.